Life Matters, a Penn Mutual podcast for financial professionals, bringing you life insurance insights from advanced sales experts and life insurance specialists. Grow a stronger practice today.
So Lindsay, last thing from a charitable perspective. So the Secure Act is now something that is pretty well settled. They just came out with some additional regulations associated with it, some additional guidance. But one of the things that it did was it made planning for IRA owners challenging from a wealth transfer perspective, because IRAs already weren't ideal assets to pass on to the next generation. One of the things that the Secure Act did was it basically took away the ability to do the stretch. We can no longer stretch the distributions over a beneficiary's lifetime. You have to take out the money over a 10-year period. One of the things that we have seen people do that are charitably inclined is to name a charitable remainder trust as the beneficiary of an IRA to, in essence, get kind of a end result that looks like the old stretch, but it's not the old stretch. How does that work, and what does that really mean for clients that intend to do something like that?
Yeah, you're right that Secure essentially eliminated stretch IRAs for most non-spousal beneficiaries. A lot of hedging language there. There are some exceptions, but for most non-spousal beneficiaries, as you said, they'd have to take it over those 10 years. A lot of times those individuals, the heir of the IRA, so to speak, is often in their working years, huge tax hit. So if you have a client that has a sizable IRA, they want to leave it to kids or grandkids, and they don't need that money for retirement, using a CRT can be a possibly good replacement, essentially, or an alternative for a CRT. And a CRT, as a little reminder, is a charitable remainder trust. So this is a charitable vehicle that allows a client to set up this trust and typically contribute an income-producing asset. And there's going to be an income stream back, so an income beneficiary, and the remainder goes to charity, and they're able to get a deduction for that. So here, instead of contributing an income-producing asset, they would instead name the IRA, or I guess name the CRT as the beneficiary of the IRA. So the IRA is essentially the asset that is going to the CRT. So the IRA would pay out to the CRT. This CRT, as I mentioned, has an income stream that's designed to pay. It could be a number of years or over a lifetime, depending how it's designed. And here, typically, that income beneficiary would be who would normally be the inherited IRA recipient or the beneficiary of that IRA. So the income beneficiary would typically be that child or grandchild. And as I mentioned, stretch it out over a lifetime or a number of years. Now, the distributions from the CRT are taxable to that beneficiary, but it's the same. It would also have been taxable if it was a stretch IRA, but here it now allows them to stretch it out and essentially function more like the original stretch IRA over a number of years that can be longer than 10 years.
Thank you for watching. If you enjoyed this video, don't forget to hit that subscribe button and turn on notifications so you never miss an update.